Good afternoon, everyone, and thank you for taking time out of your busy day to join us. Welcome to Eganberger & Weiner's quarterly webinar series. My name is Howard Pressman. I'm one of the planners here at EBW, and I'm going to be your host for this afternoon. Today, we're very fortunate to have with us one of the top strategists with one of the top money management firms in the world. So before we get started, as always, there's a couple of housekeeping issues that I want to take care of before I kick things off. We're certainly going to make time for questions at the end of our presentation, so please use the question box in the control panel on the right side of your screen to submit your questions throughout the presentation. And a replay of this webinar will be available within a few days on our media website at ebwfinancialnews.com. You'll find it under the Financial News TV tab. And by the way, if you haven't checked out this portion of our website, I encourage you to do so. There are a lot of great presentations available on a variety of topics, including past webinars. So after last year's significant run-up in the S&P 500, two of the three major indexes hit all-time highs again this week. You may have some questions and perhaps some concerns about where the market is headed in 2014. Combine that with the global political issues and the Federal Reserve Bank's actions to kind of move away from supporting the economy, it's certainly clear that this year could hold some surprises. And to help us gain some perspective on what's going on both here and abroad, how to make sense of it all, and most importantly, how it may impact you and your goals, we have with us today Kurt Reiman, who is a director and global investment strategist for BlackRock. At BlackRock, Kurt's role includes relating the investment strategies team's research and investment views to key institutional and financial advisor clients. Kurt joined BlackRock in 2013 with over 15 years of experience in investment research. Prior to his current role, he's done stints with UBS Wealth Management in both New York and Zurich, Reuters, and the G7 Group. Kurt holds a bachelor's degree in economics from the State University of New York and a master's in international relations from Johns Hopkins. So Kurt, thank you very much for joining us today. And without further delay, I will turn the webinar over to you.
Okay, super. Thanks, Howard, and thanks to all of you for sharing your time with us today to talk about the outlook for the financial markets. I hope that everybody can see what's on my screen right now, and that we are going to be able to share with you at least some of the illustrations to go along with some of the things that I'm saying here. So I will see if that's going to work, and hopefully we'll be off to the races. Then Howard, chime in if for some reason it's not working, and then we can take a different route. I always thought of myself as being somewhat technically savvy, but today I found myself to be learning a few new things. So it'll be interesting when we get to talk about our sector overweights. One of the things that we do feature is tech. So maybe take my recommendations with a grain of salt, considering some of the things that I've been learning so far. But anyway, moving right along for the past several months. And meanwhile, I think we've heard a lot from investment managers and strategists about the risks to your bond portfolio and the potential for rising interest rates and what that means for how you might want to allocate some of your exposure to what once was seen as something as rather safe and predictable, but now has some incremental risks. And then, so the equities look, at least the stock market looks like it's posting new highs, and every time we've hit new highs, we've somehow fallen quite precipitously back down. And there are all these concerns about the bond market. And I guess I would say is that looking at the market today, it doesn't appear that there are a whole lot of bargains out there. It's just a little bit more difficult, I think, to find value today than maybe if we were looking at the market last year or 2 years ago. And it doesn't mean to say that there aren't risks and news reports and issues that we have to take into consideration. That's been the case coming into and every year since the financial crisis. But I guess my point is that if you look at spreads, yields, for example, on investment grade corporate bonds or high-yield bonds, and you see just how low they've gone, and you see the market running up in the U.S., it just, there's just not that much out there that could be described as cheap. So I think it makes our job a little bit more difficult, but it doesn't mean that we're not going to find opportunities and places where we can. What I was saying before was that there are fewer opportunities, but it doesn't mean we can't find ways to incrementally boost return and also areas to limit some risk. So that, I think, is going to be important for us as we talk about the outlook for markets this year. Now, the good thing is that even though markets are somewhat more expensive and that there are some fewer opportunities, we are looking at a world where the economy is getting better. And that's something that's rather important to, I think, acknowledge in the first case. And economic growth in the U.S. is looking somewhat better. It's true for Europe. It's reasonably true for Japan. China's a notable exception. Still very strong growth, but slower than where it had been over the past 5 and 10 years. And meanwhile, what we have is, because the economy in the U.S. is getting better, we have a Federal Reserve which has been in the business of helping to repair the economy and to try to engage economic activity. They're actually moving to the sidelines incrementally. So there's less support. But in Europe, actually, it looks as though the ECB may likely be more engaged and could actually unleash some new accommodative and easing monetary policy tools. And if we look over to Japan, what I was saying before was that I think the U.S. economy is getting better, less fiscal drag. The Eurozone economy is also coming out of a recession, which I think is important, being that the Eurozone is the second largest economy in the world. It's also, I think, encouraging to see that the Japanese economy is reflating somewhat. But against that backdrop, because things are getting better in the U.S., the central banks, the Federal Reserve, and Janet Yellen will be steadily trying to pare back their monetary accommodation. But in the meantime, I think the ECB...
Picking up where I left off, the situation is that international developed country central banks are more likely to ease as the Federal Reserve is doing less to try to sustain economic growth here, because it's just not warranted as much anymore. But then, meanwhile, in the background, what's lurking is geopolitical pressures, and it's something that we've been talking about for the balance of this already throughout this year, and well before there had been issues cropping up in Ukraine and Russia. And I think that as we go through over the course of 2014, like what we saw in late January and early February when the market was down 5 to 6%, and then proceeded to rally back, I think we're going to see more periods of that. That's going to be more the norm. And let's keep in mind that we're just coming off of 2 years where in 2012 and 2013, the market never dipped below where it started the year for 2 years in a row. What's important to note here, especially about the global economy, is that we're turning higher, we think, for the first time since 2010. And that may appear as somewhat opposite to the experience that we've had here domestically, because after all, the economic environment in the U.S. hasn't been great. We've been running at about a 2% growth rate since the financial crisis, up and down, depending on the year. But the growth rate has been far better in the growth experience since the financial crisis for numerous reasons. I mean, I guess we haven't had as severe an austerity program. We've had, I think, central banks that moved a bit more quickly. We also have some domestic benefits and advantages that we can look to that others simply don't have. And meanwhile, as our growth has been okay, Europe has been slipping. They were in recession for the last 18 months. Japan previously had been in something of a funk. 2 years of the lost decades and rampant deflation. And China's economy has been slowing down quite steadily. So although growth has been good here, outside the U.S., it hasn't been quite as strong. We've been the leader, and that's likely to continue in 2014. But the good thing is that you look outside the U.S. and you're starting to see better numbers. And it's still varied by geography significantly, where, okay, China's economy is slipping, but it's still likely to come in at around 7% growth for the year. Japan's economy is one of the weaker ones, with 1.25% growth, but I mean, we'll take it given the experience that Japan has been in. And the same, I guess, could be said for the Eurozone, where growth is likely to just barely eclipse 1% after having been in recession. And meanwhile, here's the U.S. just kind of chugging along as the leader still in the developed world. And so that's a bit of a sea change, and I think it's an important one, because if we look at the next slide, what we'll see is that this better growth is also accompanied by absent inflation everywhere. It doesn't matter where you look. And in some cases, I think the risk is more of deflation, falling prices, than more slowly increasing prices. And you look at China even, which is not on this graph, but Chinese CPI is down below 3%. In the developed world, Japan is just finally getting out of deflation because they've had such a weak yen, and they've really been printing money to try to sustain some form of reigniting the economy. And here in the U.S., you look at core inflation, which excludes the more volatile segments of food and energy, and it's been holding in at a rate that's, you know, just around 1.5 percentage points. So the inflation's pretty well absent. And if you look back in time, and I do mean for this to be somewhat superficial. So, and I'm sure you're going to think it's the case, but just as a starting point, if you look back in time and you see periods when inflation is subdued and growth is getting better globally, typically what you would be benefiting from in your portfolio is owning developed market equities, emerging market stocks, investment grade, high yield corporate bonds, commodities to some extent. And where you would be more reluctant to have positions would be in safe havens, things like U.S. Treasuries. I would even say, for example, high dividend yielding stocks like the utility sector doesn't do as well. Gold doesn't do as well. You look across these safe havens, including TIPS, they tend to underperform. And that I think as a starting point, is a good place to sort of leave maybe this very broad macro discussion and then think about some of the nuances and why maybe we don't want to take that superficial approach to investing. And here, you know, you move to the next slide, and what we can do is we can walk through some of the economies. We'll do a bit of a global tour. We'll look at the U.S., Europe, and Asia, and then we'll dial in specifically about what we want to do from an investment standpoint. So the U.S. economy, we've already spent a little bit of time on the U.S., but I think it's worth just going in and looking specifically at some of the undercurrents that are going on, and that we can see on the next slide. The first thing that I think is really important to point out is that the consumer is not likely to be all that enthusiastic, because even though the labor market is healing, we've gotten better numbers on the job front, we have higher non-farm payrolls, we've got lower claims for unemployment insurance. If you look at the unemployment rate outright, that's fallen. Short-term unemployment has fallen. All of the cyclical indicators would suggest that there's some healing going on. But the participation rate has fallen. Some of it's because people are retiring, but others are just not simply finding jobs and they're dropping out. Real wage growth has been anemic, to say the least. We're seeing wage growth picking up, but it's at levels that we saw in prior recessions. Real disposable income is growing this decade at the slowest rate since we have data, going all the way back to the 1950s, at a range of around 1.5%. Retail sales are holding up, but a lot of that spending is coming from people dipping into their savings. So that's not terribly encouraging from the consumer side of things. Also, if you look at household formation, which is a really important part of consumption, the typical run rate of new household formation is about a little bit over 1 million. Last year it came in at 450,000. And the early signs are that there's not that great of a pickup in 2014, even though the job market's getting better. And you've heard numbers about better housing starts new home sales. Well, the housing starts and the housing completions are mostly in the area of multifamily homes, apartments, and less in the single family. And it's my view, and I think it's pretty widely held, that an additional home in the multifamily space is going to create less purchasing of consumer items, because you're not necessarily going to call this the place you're going to live and raise your kids and form a family and perhaps even retire. It's more transient, whereas single-family homes, people tend to spend more on furniture and white goods and things of that nature. So I would say that there's still some weakness on consumption, and that's been the part, especially when you mix it with the really cold weather in the early part of this year. That's the part where I think we've seen some disappointment. The year started out with economists looking for 3% plus growth in the U.S., and our forecast was closer to 2.5 to 2 3/4. So better than where we've been, but we weren't as optimistic as the street. And I think that the real variable that's been disappointing and is more consistent with our less positive view on economic output is really coming from the consumer. But there are some bright spots, and one real big one is what's going on in Washington, D.C. Now, I'm not saying that there's been this great kumbaya moment in Washington, far from it, and we don't have to like what's going on in Washington, D.C. We don't have to support the job that Congress is doing, right? And most Americans would say that they don't approve. Actually, there's 10% of Americans who still think Congress is doing a good job. I'm not sure who they are, but they still there are still some out there. But the point is it's not about how we feel about D.C. It's about the trends that are taking place. And one of the big sea changes, and it's not permanent, but it's good for now, is that the deficit as a share of GDP has fallen from 10% in 2010 to under 3% today. And that means that there's less wrangling over and less need for revenue increases and spending reductions. So the drag that we got from growth coming from the government has faded and will likely continue to fade. And the political uncertainty that's associated with this has also faded. And what happens when uncertainty starts to fade? Well, you get more animal spirits. Businesses start feeling better about investing in their future prospects. You get this also added benefit that not only are they investing in things like, new computers and productivity enhancements and all of these, upgrades, antiquated machinery, they also start buying other companies. They also feel better about buying growth. And so two themes that have really started to kick in this year. Number one is that we've seen better mergers and acquisitions activity, which is pretty helpful, and it's largely been in the United States. And the second thing is that CapEx, or capital spending, investment in plant and equipment and associated things, that's important, and it's a driver of growth, and we think it's going to hold up this year. And I would also argue that you've probably read about it in the Times or the Wall Street Journal or elsewhere. You've heard about this debate on income inequality. Well, one of the things that you can take away from that is that you do have a number of workers in the U.S. that are highly productive, and they're not getting paid that much relative to workers overseas. And when the comparison should be made against other developed countries, not versus other emerging markets. And when you take the energy renaissance, the exploration of natural gas and shale oil that's been taking place in the United States over the last 5 years, you mix that cheap natural gas with a fairly productive worker, and you've got a eureka moment for manufacturing. You have this really nice convergence of trends that positions, for example, chemicals companies, steel, cement, pulp and paper, all of these industries would tend to do well on the global stage, which is beneficial for exports. And we don't have that strong of a dollar to really curb the U.S.'s manufacturing ability. And we can export more now because, as I said before, we think the global economy is looking better. So that's a bit our sense of how the U.S. is going to fare. But if we look on the next slide, what we'll see is that the Eurozone is going through a recovery process that we already started going through in 2010. When the cyclical turn really began with manufacturing indices turning higher, better numbers on retail sales, the risk premium on assets started to fall. All of these things were beneficial. Unemployment numbers weren't rising anymore, and in fact became lower over time. These are all this is all evidence of healing. And so I think if you look at the Eurozone, you've got a pretty clear argument for a sector, and a large sector of the economy, the second largest regional economy in the world, that's going to be picking up steam. And I will also acknowledge that Europe still has a lot of structural problems that they have to work through. The U.S. economy does too. Some of these structural problems include a high debt load, very high unemployment rates. In some countries, it's over 25%, Spain and Greece. And in Spain, the youth unemployment is over 50%. And I would also say that it's becoming increasingly likely that there's going to be a shift more to the right and to parties that aren't as supportive of the Eurozone project as a whole in May, in just a couple of weeks, when Europeans go and they vote for the European Parliament. So that tends to amplify a bit, I think, the overall sort of concern about the Eurozone, and a number of skeptics about the Eurozone will cite these statistics. But I would also cite a few other things that I think are important. One is that the factors that led to a fraying of the fabric of the Eurozone, which were high fiscal deficits in peripheral countries, gaping current account deficits, meaning you had more investment than your economy could support, and uncompetitive workers have all been pretty well fixed. Fiscal deficits are mostly repaired, and they're not running surpluses, but they've moved off these deep deficit levels. Current account deficits are now running at balance or in surplus, so your external account has been helped. Then largely these two go hand in hand. So any repair of the budget deficit is seen in the current account, and that's really helpful because these two things were pulling the Eurozone countries apart. And then a measure of labor costs and competitiveness, which you can gauge, unit labor costs, have been falling in these peripheral countries. So yeah, there is a high unemployment rate. There is a high debt burden. But I do think that we're at the stage now where some of these countries can start contemplating growing a little bit out of these problems, as opposed to before, when their efforts really to stem these gaping holes in their budget deficits and in their external accounts actually was subtracting from growth and adding to unemployment. They don't have to do that anymore. And we're seeing this better tone reflected in European bond spreads. We're seeing that start to tighten. So what Greece and Portugal and Italy and Spain all have to pay to finance debt, that's been coming down. And I think that's a good sign. Now, in addition to all of this is what the ECB would or wouldn't do. And for the better part of the last couple of years, the ECB has said, absolutely, we're not going to participate in this balance sheet expansion that we see at the Federal Reserve. And most of this has been because Germany and the Bundesbank officials have said, we just don't support that kind of a policy approach. It's not sufficient. Well, you've had Japan really doing a lot of work to weaken their currency, and Japan's economy is very similar to Germany's. And Germany's now looking at inflation in the Eurozone, and they're seeing it move ever closer to the zero line. And I also think that the fact that they don't have to worry as much about having to ship money overseas to deficit countries because they've fixed their deficits, I think that's also faded. That means that the ECB, I think, has more room to act. And as soon as this June, you could start seeing the European Central Bank and Mario Draghi talking about lowering interest rates and maybe even eventually engaging in their own form of targeted balance sheet expansion, buying assets to help repair the banks. So we're overweight the Eurozone. We like what we're seeing here, and we think the Eurozone is cheap, and I can get to that a little bit more as we go through some of the investment ideas. But just rounding out the global economy a bit, and we look at Asia, just advancing over to the next slide, what we see here is something that I think is important for investors to focus on, and that is the reflation of Japan and the slowing down in China. And these are going to be really important variables in whether the global economy does actually accelerate this year or not. And my feeling about Japan is that longer term, we really do have a problem here. We have a country with a very high debt load, 250% of debt relative to GDP, and the economy is getting older and shrinking. And as they look at their future prospects with these kind of demographic overhangs and debt problems, they really do see this as their one last attempt to reinvigorate the economy, with China becoming an ever larger presence economically in Asia. So our view is that Japan will successfully reflate. It's going to take some time, and a lot of it's going to come on the back of currency weakness. But as the currency weakens, what happens is that it's generating inflationary pressures domestically. But then in addition to that, you've got efforts from political officials for companies, small and large, to raise wages. And they're also trying to cut the corporate tax rate, which I think would be beneficial to Japanese growth. And a lot of other, sort of structural changes, like trying to get women into the labor force. And I would say that you could call me a skeptic on some of these longer-term changes, but on the near term and the efforts that they're making to really try to engage risk-taking activity and businesses to try to, really re-engage and get more oriented towards growth and domestic demand, that I do think is going to work. And if you repatriate profits with a cheaper yen, they start to look better on corporate balance sheets. So Japan is an interesting story because I think it has this really, really odd dichotomy between what's going to happen short term and really big question marks about the longer term. China is a country where I think this year and last year and the year before that too, and rightly so, a lot of analysts and economists have been steadily ratcheting down their growth forecast because China's got a credit problem. Everybody knows this. It's not at all a secret that they have overbuilt, they have overcapacity, they have capacity in some industries that just will not get used. And we know from our own experience that whenever you have a credit overhang, that is typically either a bumpy ride or quite damaging for investors. I think one thing, though, that differentiates China from ours is that we had some pretty interesting assumptions going in. One of them was that all Americans should own a home. Another one was that house prices nationally never fall. Another was that subprime, and this was Bernanke's testimony in front of Congress, was that subprime wasn't likely to become a systemic risk. I think in relative terms, we more ignored the creeping asset bubble and the problems that would further come down the line, whereas we're seeing steps that Chinese authorities are taking not only to address the credit problem, but to reform their economy. They're doing things like trying to give, they're giving benefits to rural migrants that work and live in the cities but don't get the same kind of social benefits. That would be good for consumption. They're widening the band for their currency, which gives a bit more flexibility for international investors to know what the true price of their currency is. They're liberalizing their financial markets. They're making steps to introduce these new free trade zones, which is, I think, a big step. My point is I think maybe actually, I'd rather say that not maybe, we're at a point where the investment community and economists have really piled on, and it's become this haters club in terms of Chinese economic output and investment potential, and not giving any benefit at all whatsoever to the reform progress that they're making. And I think we're at a point now where if we look back a year from now or 2 years from now, we'll see this as an opportunity to invest. So if we look at the next slide, what we'll see is a bit of just a showcase of this monetary policy framework that I think, interjecting throughout some of the discussion. This is just helpful for illustrational purposes. And I think when we look at the Bank of Japan, which is this dark blue line, we really do see just how much they're doing to bloat their balance sheet, to reinflate. And I think this is something, if you believe in the adage, don't fight the Fed, then in this case you really don't want to fight the Bank of Japan either. And the Federal Reserve, you can see, is that kind of greenish line, and that's been growing, but growing at a slower rate because they're not buying as many bonds. And we think by October, the Fed's going to stop buying bonds altogether, and that by the second or third quarter of next year, they're actually going to start raising short-term interest rates. Meanwhile, the ECB, which is, I'm colorblind, so it's really hard for me to tell you what color this is, but I think it's red. But it's the one that's falling where all the other ones are rising or flat here in 2012 and 2013. And that is the ECB. They've actually been letting their balance sheet shrink, and that's been putting upward pressure on the euro, and I think it's also been one of the factors that's been pushing down inflation. So really, the ECB has been taking a completely different approach, and I think that they're going to have this less dogmatic and maybe a more pragmatic approach to setting monetary policy. And if we wonder about the effect of the Fed and what they're going to do this year, I guess my argument would be that a lot of the backup in interest rates happened already last year. So the pricing in of the Fed's unwinding of this overly aggressive, accommodative monetary policy has already been priced into the bond market. There may be some incremental additional yield increase because of what the Fed is doing and backing away, but I'm really not all that concerned about it because we saw last year interest rates rise by 130 basis points. And what's interesting is that this year the Fed's actually deepening the process of normalizing monetary policy, and yields have fallen. So I do think that we're coming out of this period where we have to be necessarily concerned about what the Fed is doing, especially because you've got other central banks globally that are making efforts to reflate their economies. And it doesn't mean that looking at the Fed, I do think that they could inject some additional volatility into financial markets because it's not easy to exit quantitative easing. It's not easy to raise interest rates. Bernanke, in retrospect, had a hard job, but relatively speaking, I think he had an easy job. His approach to exiting quantitative easing is to retire. He's handed that over, the baton over to Janet Yellen. We're still getting to know her and her philosophy. She seems quite concerned still about structural unemployment, although there's a lot of questions about whether the Fed can do anything about structural unemployment. We'll be wondering whether the Fed is going to be raising interest rates in measured steps or whether they'll be doing it in quarter or half a point increments. There's still a big question mark about what level they sort of get to when they feel that they've raised the short-term interest rate enough. I don't think that's been answered. So a lot of this can still inject volatility into financial markets, but as far as pricing for the unwind of this balance sheet expansion and the end of days when the Fed's buying bonds, I think that's mostly been priced into markets. So moving right along, on the next slide what we see is a bit of a just a sense of where geopolitical risks could come into play. I think that just to illustrate why I think policy uncertainty is very low, you can see that on the left-hand side. Where I think the geopolitical risk could be rather important, though, is on, you can see on the right side where oil prices are still over $100 a barrel, and there's a non-zero probability. I think it's still less than 50%, but it's still out there, a risk that Russia could curb some of the supplies to the West, and there's a never-ending litany of factors that we need to monitor coming out of the Middle East. And I guess my point here is that when you have a period when geopolitical risks are elevated and the economy is still rather weak and there's not as much wiggle room if things go wrong, that especially if oil prices were to go up, say, $10, $15, $20, $30 a barrel from where they are today, that would be a real shock to the economy, given as weak as it is. So we need to monitor that and keep that front and center in our portfolio and in our investment decision-making process. On the next slide, just a little bit of a point on volatility to say that it's low, and it doesn't matter if it's in the stock market or the bond market. Right now, investors are rather complacent about, I think, geopolitical risks, the unwind of the Federal Reserve's accommodative stance, and then eventually raising interest rates, and also about the potential for us to just simply miss on economic and earnings numbers. We're not prepped for it. The volatility is low, lower than I think it should be. And what I'm going to do now is I'm going to skip the next slide because I want to just stay close to our time allotment here and get to questions, and that is just to start working through what this means for investors. And I do think the equity market is going to end the year higher than where we started. I do think that we're going to be punctuated by periods of volatility, and so I would rather own large caps than small. Large caps are going to give me, I think, greater ballast in my portfolio because they're more globally diversified. They have less sensitivity to rising rates, and rising rates can have an impact on the stock market, especially if they rise too fast. And there's activist investors that are getting involved and try to unlock some of this high cash balance that you see on stock portfolios. The companies today have a lot of cash. They've been paying it out in the form of dividends and share repurchases, but more and more they're looking to invest. They're looking to buy companies. That's healthy, and I think it benefits the U.S. large caps, which have really lagged the small cap sector over the past several months and quarters. The other thing that I would emphasize, energy is a good sector overweight in your portfolio to hedge against geopolitical risk, the kinds that we're seeing in Ukraine and Russia. It's also cheap, and I think we're starting to see some of this return on invested capital that was hurting profitability start to actually benefit the companies that are in this space. And if you, we're sort of indifferent whether you want to position this globally or whether you want to take some exposure to U.S. refiners and servicers who are really participating in this energy renaissance that we have here. We also like tech because it's a business staple. They need to buy technology products from mature companies that sell PCs and servers and software and peripherals and devices. This is something that I think is really it's not so much a cheap sector as if I look at tech and I see the growth in the dividends that they're paying out, and I look at the volatility of technology relative to the overall market, and I see that it's not as volatile anymore. It used to be 15 years ago, but it's really changed quite a bit. I see technology as more of a staple and less of this sort of high volatility, high growth, sexy sector. It doesn't mean that there aren't some. You have the social media, Internet of Things, 3D printing companies that that were really hurt badly this year because of the rotation out of biotech and some of the internet stocks. But this isn't really the tech that I'm talking about. I'm really referring to large cap, more mature growth phase companies that I think can deliver here. And where we're underweight is in the consumer. You remember what I said about the U.S. consumer remaining somewhat weak? I would be underweighting consumer staples and consumer discretionary as a result of that, as a way to really get some protection in my portfolio from low real wage growth. And just you really have to have a better household numbers, better household formation, housing numbers, better wage growth to support what we would need in terms of earnings to get these kind of valuations. Another sector that I like is financials. We just raised that to an overweight, and it's because you still have a pretty steep curve. You've got better loan formation. Banks are more willing to lend. Companies are more able, and households are more able to borrow. And this is a global sector, and if we look across to Europe, their improving economic outlook and the potential for the ECB to just get a little bit more pragmatic in their policy approach would, we think, be supportive of financials. On the next slide, what we see is some relative valuation from geography. And I just want to point out that the U.S. has a high price to book and a low dividend yield. And that would be, if that's the case, high price to book, you're expensive. A low dividend yield means that you just have less coming from income to help you out. I would like to trim up some of that U.S. exposure and take advantage of some bargains that I'm seeing in Europe, and particularly in some of the peripheral countries like Spain. There are some bargains here. If you want to stay safe and you want to keep with Germany, that's fine too. Germany is also cheap relative to the U.S. I think basically you're paid for looking to non-U.S. developed markets. There aren't any bargains, but in this space you can look to cyclical sectors in the Eurozone that have a favorable dividend yield to what you would get on a defensive sector here in the U.S. And on the question of emerging markets, when we're looking outside the U.S., I would just say that you run a risk of being underweight emerging markets. They've really done well in the last month. They haven't totally recouped. Obviously, they're still far away from recouping their negative performance. They're also a long way from recouping all their flows, but investors are moving back into emerging markets because they saw some cheap valuations, and it got a little bit oversold here. And I would argue that the trend over the past couple of years wasn't so much about emerging markets doing poorly. It was rather developed markets that were pulling away and were doing so well. And so you look at developed and you compare it to emerging markets, and I think there's an argument here to be made that there's a bit too much fear baked into emerging markets right now, and that to have too material and underweight position to a part of the world that's growing, that's reforming, I think would be a mistake. So we like emerging markets. We're not overweight, but we just would caution against being materially underweight here. Shifting over then to the bond market, what I would say here is it was clearly the case that we wanted to be prepared for a backup in interest rates. And the trend that took place over the last 12 to 18 months was investors moving out of higher maturity, longer maturity investments and into the short duration, short maturity part of the curve. And investors also moved from short maturity and short duration and treasuries increasingly into credit. So we now own more corporate bonds, investment grade and high yield, more bank loans. And I think our bond portfolio has really changed quite a bit. That it's no longer there for safety and preservation. It's actually there to generate a yield and generate income, and we're taking on ever more risk. And so first and foremost, I would say, evaluate your strategic asset allocation, see where you are relative to that, and do you have enough ballast in your bond portfolio if things were to get a bit bumpy here? And my concern is that we have equity-like risk in the bond portfolio at ever increasing percentages. And so, if the stock market sold off, then there's going to be a part of your bond market that's going to trade in sympathy with that. And if it happens against the backdrop of higher interest rates, then it's really going to be rather painful. So that's my word of caution on the bond market, is that it may make sense in some cases to look to opportunities to get more maturity exposure, get some rate exposure back into your portfolio, get some safety, because you're not getting compensated anymore for taking on a lot of the risk of being overweight high yield and investment grade corporates. We just think that the value isn't no longer there given the risk that you take. So we would lighten up on our high yield exposure. You can look to the next slide and you can see in the case of municipals, there's actually quite a convincing story to be told there. And there's been really impressive performance in the muni market, 6% returns this year. You look out to 15 and 20-year municipal bonds and you see that there's yields out there that are over 6%, and there's not much on a taxable equivalent basis, and there's not much out there that investors can get where they're going to be able to recoup that kind of a yield. So I would look to actually position longer duration maturities in the muni market. I know that sounds a bit different from what a lot of strategists have been advising. We've been saying that you should be shortening duration, but I think in some cases you actually get paid to take on longer maturity exposures. And after this year's April sticker shock from the tax filing deadline, I think investors are looking for ways to get a better after-tax yield in their portfolio. That's beneficial to munis. On the fundamental credit picture, I would just say, yes. I mean, we do have issues emanating from Detroit and Puerto Rico. We can talk about that more if you have questions, but I think broadly speaking, because sales tax revenues are picking up, the housing market's better, property tax revenues are picking up, state and local governments have cut spending, their revenues are pretty well intact now. I'm not terribly concerned over the next year to two about how the credit picture appears in the muni market if you're in high credit quality municipal issuers. So I think you really do get paid to take on some duration risk, to get some maturity exposure, and to think about overweighting municipals in the portfolio. Howard, I'm going to ask you if you could please just do advance a few, because I want to pause there. There's some additional slides that we could go through about correlations and so on, but I think that's a bit, maybe we could save that for another discussion. If we stuck here, though, just before questions, prior to the disclaimer on that rethink your bonds, seek income but don't overreach, and manage volatility while accessing growth, I think that's a good slide to just keep up there for people to look to just as a bit of a recap and a conclusion. But what we want to do is I think open it up to questions so that you and your clients can ask what's on their mind.
All right, great. Thanks, Kurt. So if you have any questions, go ahead and submit them again using the questions pane on the control panel on the right side of your computer. I've gotten a couple throughout the presentation, so while we're collecting some additional ones, I will go ahead and fire off just a couple here. So you talked a little bit about China and perhaps that it is slowing. One of the questions is how do we know that, and can we trust the information and the numbers that are coming out of China?
So yes, you cannot necessarily trust the data, is what I would say. That it's going to be influenced by what the state is looking to communicate, and so you can look to some private numbers that are better. The HSBC Purchasing Managers Index, which is a good read on manufacturing activity, I think would be something that I would put my eye on. And then there's several private indicators that blend together, for example, rail shipments and electricity demand and some other cyclical readings on the economy, and they blend these all together into an index. And what they show is that there has been a more material decline in economic activity than what you're getting on the national government's reading. That said, the government's saying that growth this year is likely to come in at 7.5%, and the official story is that growth is about just south of that. 7.4, I believe, is the most recent number. Whereas the street economists have growth coming in now because they're looking at some of these other indicators as coming in below 7%. And that seems reasonable to us because anything less than that level starts to raise questions of social problems, because you can't necessarily employ enough people to get them as they migrate from the agriculture to the manufacturing and eventually to the services economy. You unlock a pretty large labor force. You need some growth to do that, and it will be a fine balancing act about slowing credit growth and making sure that you still have growth in traditional industries, and that you're getting more growth coming from the important area, which is the consumer. And my sense is that the forecasts of slower growth have mostly been baked into asset prices today. But the reform agenda, which is going to unlock the consumer, which is going to put less dependency on credit, which will free up more of private enterprise versus state-owned enterprise, all of these things, they matter. And I do think that reform dividend will start to get priced into Chinese equities. It already has over the past several weeks. I would say that it's too early to gauge whether this is a long-term trend. There could be some additional weakness as we go through the year, but I do think this is a good entry point to be looking at China.
Okay, great, Kurt. Thank you. So, are there any emerging markets that you prefer over others?
Well, in terms of countries, yeah, we are overweight China. We're also looking to get some incremental value by owning Poland, which tells you something about our view on whether Ukraine and Russia will be able to see an off-ramp here, because obviously Poland is right in the periphery here, but we do think Poland benefits from an improving Europe, and especially because they're, if you will, they're the Mexico relative to the U.S. and Europe relative to Germany. So they benefit a lot from improving economic activity in the U.S., and it's a cheap market. And we're also overweight South Korea, which some would argue isn't really an emerging market anymore. They've emerged. They're a developed economy. But they tend to benefit from this increase in capital expenditures, more demand for technology in the workplace and to get things done. And it's also a cheap market. They're turning off what looks to be pretty decent earnings numbers this year. Where we're underweight, it's rather slim pickings. We're underweight South Africa still in our asset allocation, but elsewhere, we're running mostly neutral. My follow-on point to all this, though, would be to say that I think this is a good time for generating outperformance, and that managers have a pretty good opportunity here to be looking at countries like Mexico, which are more fully valued, something of expensive, where the reform is ongoing, and I think there are pretty bright prospects for Mexico. Some of the countries there may be, companies, excuse me, may be rather expensive though. And then you've got India on the other hand, which is also going through a reform phase where there is this market that's still, I think, relatively speaking, cheap, and there may be some really strong opportunities. So managers that can weave in and out on a country, sector, or company basis, I think, are at a point now where they can really outperform.
Okay, great, thank you. All right, so I know we're pretty much at our 1:30 mark. So I do have one more question. So Kurt, if you don't mind answering it, and if you all don't mind hanging in there. Let's see. So based on the Fed's quantitative easing and bond, asset purchases as they pump money into the economy to get it to grow, do you see any repercussions to that? Perhaps any sort of dollar crisis?
Yeah. Well, I don't see a dollar crisis coming from this, and it's really this is something that we've been talking about for several years. Especially in 2010, I remember quite vividly the ramp up in debt, the high deficits, the beginning phases of the balance sheet expansion, and so many investors were doom and gloom on the prospects for the U.S. dollar, to the extent that even the dollar was going to lose its reserve currency status. And I just don't see that. China's economy may very well eclipse the U.S.'s economy in very short order. But that's what happens when you have 1 billion people and you multiply it by a low per capita income. Just simply speaking, they've got a lot of people, and they're able to generate more economic output, but their per capita income is still pretty low relative to the United States. And we've always, as a country, we've always looked over our shoulder. I mean, you can all remember when we thought that Russia was going, or the Soviet Union was going to eclipse the United States. And then once we dealt with that and the Cold War was over, everybody was worried that Japan was going to be the next country to overtake the United States. I'm not sure that anybody thinks that Japan or Russia today are in that position. So now the new threat is China. And so I would just from the standpoint of the dollar, I don't think that the Fed's money printing is going to create a dollar crisis and the end of the reserve currency, but it will have repercussions. Now, here's can I just add what they might be?
Sure.
Yeah. So the repercussions to me are hard. I think, number one, they're really hard to say because this is an experiment. This is something that hasn't been done before. We're in a fiat reserve currency regime since only the early 1970s, and there's never been this kind of change in the system that we've had right now. But so looking at it though, and I not saying what should happen, but rather could I maybe reasonably project what could happen over time, and that is I would say that maybe higher inflation is something that we ought to be on the lookout for. How much, when, and in what form are very difficult to say. But from a political economy standpoint, you have the Fed, which owns quite a bit of Treasury debt. You've got the government, which basically took private sector debt and put it on the public sector's balance sheet. And that debt load is I think, going to be an impediment, especially if you have rising entitlement burdens over time, starting, later in this decade, really starting to pick up. So I guess my point is I think there's an incentive for central bank officials and for elected officials more broadly to support a regime of higher inflation than we may be used to as a generation. And I think that is something that we should already today factor into our portfolio. So yeah, it will matter. Right now, I think that the importance of what we're seeing in terms of balance sheet expansion is supportive of taking on risk asset exposure like stocks and real estate and getting some exposure to dividends and maybe even investment grade credit and having that in the portfolio. But longer term, I would start looking at this now, but baking into a portfolio some inflation hedges I think would be warranted, because a lot of these are still viable and not terribly expensive. And one great inflation hedge, if inflation doesn't rise too much, we have to keep in mind, is stocks. So it a bit plays into our current view that stocks will outperform bonds, and longer term, that if we do have a pickup in inflation, that stocks are going to be one of those assets that do better.
All right. Well, great, Kurt. Thank you very much for your time today. And I guess really sum things up quite quickly. It's lots of things going on, but staying diversified is clearly the best course of action to address the myriad of risks and certainly to take advantage of the great opportunities that are present in the market today. And thank you very much for all this great information and for delivering those points. Really appreciate it. And of course, thank you all for taking some time out of your afternoon and spending part of it with us. I hope you found the information to be beneficial. As I mentioned earlier, we will have this available for replay in a few days at our website, www.ebwfinancialnews.com. You can probably fast forward for the first 10 or 15 minutes of it if you want to. Again, I apologize for the technical difficulties, and I thank you again for your support and your patience. And of course, if you have any questions on anything that we've discussed and how it may impact you and your portfolio, I encourage you to get in touch with your financial planner, and we'll be happy to go through that with you. So with that, I wish you all a very wonderful afternoon, and look forward to next quarter when we do our next webinar. Thank you all very much.